front and not wait till, again, big technology company they realize that there's their consent or sign off or something is needed. So try to take care of that in advance. Promise bonuses, I've seen that pop up. So again, nail all that stuff down. Vesting, it's kind of I know when I was talking with Nathan about different points that I wanted to discuss, the vesting point seems a little bit off. Why talk about how much vesting is left? It's a very particular legal issue, but if you again are blowing out early, where some of the founders maybe have a couple of years left on their equity vesting, 280G golden parachute rules can apply. What does that mean? It means that for all the accelerated equity, whatever the value of that is, a 20% excise tax can hit you. How do you avoid it? You get disinterested shareholder approval. Who are the disinterested shareholders? They may be your minority shareholders, or somebody that you don't want to treat badly for the couple of months leading up to this thing. So keep that in mind. The PowerPoint, this was something actually that I think you had raised, and I think the takeaway was, what does your PowerPoint, your business plan include? The big unproven vision, that can be instrumental in getting acquired. You're going to knock things back and forth with the biz dev person, then maybe with the engineering team that kind of adopts you and says, yeah, we can do all of this with your stuff. This is going to be great. The issue is that you're going to be likely to make a representation and warranty to your acquirer that you have all the assets and all the IP necessary to operate the business as currently, and here's the gotcha, as currently proposed to be conducted. Big issue. Normally, most companies won't back off of that, particularly again when you're talking about a purchase price that's reasonably low, and they're sort of like, hey, take it or leave it. So how do we deal with this? Usually just an indemnification cap. That's your only comfort, that they're not going to sue you for more than X if you don't end up having all the IP necessary. Why don't you hit the other couple of points?
As soon as you start to think that you may want to sell your business, make sure that you don't start signing long-term leases, long-term contracts to acquire equipment, rent. Do anything short-term as less expensive as possible. And as Todd said a few minutes ago, make sure everything that all of your side agreements or your verbal agreements have all been reduced to writing.
If we got a minute or two more, I've got a couple of things post getting into the solicitation process. The big one is really try to avoid engaging with just one acquirer. You really will do yourself a big service, even if it's the appearance of having two folks in the race. When you engage just with one acquirer, it's not that they're bad people. They're just doing their fiduciary duty as well. And if they get you far enough down the line and they believe that they can take that price down, they really will take the price down, and it'll usually come from the CFO, the controller's office, and I've seen things get really painful there. I always like to tell my clients when they come in and maybe they have some interest with somebody is to kind of set the table a little bit ahead of time. Verbally communicate what's important to you in terms of whether it's price, whether it's very low indemnification or escrow or holdback, whatever that might be. You do yourself a big service to let them know ahead of time, because once it's reduced to writing, it becomes the horse trading. It's the same thing I always tell my clients with venture term sheets. The more you can try to pre-negotiate before that first term sheet hits, the better off you're going to be. Finally, on the NDAs, you do want to get those signed up front. A lot of times the company that's looking to acquire you, may very well, be doing that sort of buy versus build calculus, and if they get a big look under your hood and then things don't go the way you were hoping that they went, you can be on the short end of the stick if you don't have some kind of NDA in place. And actually, again, unlike investors or VCs that you're never going to get an NDA out of, you should be getting an NDA out of when they really want to look under the hood from any potential acquirer. And I always like to make sure you drop a non-solicit in there, because they may just say, well, the deal cratered, but we can get so-and-so engineer. If you don't have a non-solicit covenant in there, it's very possible they may go after one of your key co-founders and then just bring him on, and you guys will be kicked to the curb. So I think it's always a good idea. And that is it.
All right. Can we have a round of applause for these guys? Yes. Nicely done, nicely done. Hopefully a few nuggets there that'll keep you out of trouble and avoid paying taxes to the full extent. Next up, let's have Russ Fraden come up. Are we set up here?
Sure. Yeah, look at that. Magic.
Awesome. Take it away.
Can everybody hear me okay? It's okay? Cool. I don't have a microphone. You want a mic? You want a mic? Okay. Someone gives me one. There we go. Now, can everybody hear me okay? Cool. All right. I'll move over here so I can see my own slides. So I'm going to try and talk for 15 or 20 minutes and then take questions. Happy to answer questions. My goal in this presentation, even though right around the middle it's going to seem like my goal in this presentation is to bum you out if you're a founder of a company, that's actually not my goal. My goal is to reset the way you think about your startup journey. I've been truly blessed. I've been working at tech startups for the last 15 years. I was an early employee at 3 and a founder of 3 tech companies, 2 IPOs, 3 successful M&A transactions, 1 disaster M&A transaction. This is the most important note. If you are writing notes, write this down. Do not take money from Baker Capital under any circumstances. If your other choice is bankruptcy and jail, go to jail. I say that that's my revenge. I say that every time I speak anywhere. I've worked on 4 or 5 other M&A deals. I've raised 12 to 15 venture rounds. I've probably done 30 angel investments in the last 2 years, and I've been on maybe 5 or 6 boards over the last 5 years. And I say that to just I've had some amount of decent experience. My most previous success was I was the founder of a company called Adify with a couple of other guys, and after about 2 years, Cox Enterprise bought us for $300 million. But before that, I was at Flycast and Comscore and other places like that. And my favorite thing about this is very cool. I didn't realize until I actually pulled it up on my BlackBerry halfway up to the city, while I shouldn't have been looking at my BlackBerry, is I actually started my career in this office building. Flycast was started in this space, and our IPO party was here. It was very cool. So probably the first presentation I ever gave in my entire work career was right here to Flycast, and so I'm glad I get to do it again. So this is one of the things I wanted to point out, and this is pretty important, and I don't mean it to be funny. I mean it to be real and for folks to think about it. You're not going to sell your company. It's not going to happen. It basically never happens. Everybody living in Silicon Valley misunderstands it because you go to speeches where they take the very lucky outlier folks and have them give speeches to rile you up like you're going to do it. And then you read, and everything in the press all day long is, every now and then companies that shut down, but companies rarely shut down, relatively speaking. They mostly just continue and pivot and raise a little more money and continue. And that's okay, but you need to understand you're not going to sell your company. And at an early stage, you're really not going to sell your company. Maybe if you do a really good job, you'll get lucky and someone will want to buy your company. But the good news is this next part and all the advice I'm going to give you, it's all around building your business anyway. Any exit's going to be thanks to the quality, skill, intelligence, and hard work of a great team. So Nathan asked me to give my Adify story. I'll give you my Adify story, but then I'm really going to focus the presentation on advice. So my Adify story is we had a great idea, and I had great partners to build the business with. We had an early group of folks that had worked together before. My CTO and I were the first 2 employees at Flycast. We've worked together. We were college roommates. We've worked together for 18 out of the last 20 years in 6 different companies. Really enjoy working together. My co-founders with Adify were the 2 original founders of the company I first worked for. So just a great group of guys, and I was excited to go to work every day. And we had a cool idea. So we went and raised a bunch of money from Venrock, and we set about building our idea. It took us about 9 months to build it. Started pitching it, started getting clients, really started taking off. We raised our Series A, kept building the business. We raised our Series B. We continued to build the business. That's very rude when my own cell phone interrupts my presentation. Sorry about that. I'm not going to answer it. I'm just going to turn it off. That would be funny, actually, I guess.
Sounds a good story.
Yeah, it would be good. So we raised our Series B. We started getting a ton of buzz. USVP, so Venrock did our Series A. USVP, a newly formed, although it no longer exists, NBC's venture arm called Peacock. Equity invested in our round, and Time Warner Ventures invested in our round. If people want to ask me later in Q&A, I have a lot of opinions on strategic investors that are different from almost everyone I've ever heard talk about strategic investors. I think they're actually a very good thing if you can work with them at your company. I mean, they're dangerous, but all investors are dangerous. So we raised our B and we kept building our business. We were getting tons of press, but we were getting tons of press because we actually had a cool product. We didn't spend a lot of money on PR. We didn't make stuff up. I didn't go out to parties. Well, now I have kids, but I've always been very boring. This is about as late as I go out to do anything. And so we didn't go out to parties. We weren't front and center. We weren't trying to get ourselves out there. We were just building something cool. We had a lot of customers. They paid us money. We were growing. We were a market leader and a cool idea. A lot of people wanted to chat with us about buying the company. I'll tell you a story about this later. I guess I won't name names. Well, I'll tell you a story now, and then I'll tell you the advice later. I was in London once. We had clients in 19 countries. I was in London once, and I pick up my voicemail back in the office, and this guy says, "Hi, my name is," I remember his name, but "Hi, my name is XYZ. I'm in the M&A group at Yahoo. I just worked on the acquisition of Right Media. I've never met this guy. Just worked on the acquisition of Right Media. I think I'd like to buy Edify. Please give me a call back." That's pretty direct, right? You don't generally hear that. It was pretty direct. You can't get distracted by this crap. It might happen. Every startup in this room, if you do anything cool, you will have a conversation where someone who is a much richer company than you tells you they want to buy you. That's different. Again, you will not sell your company. Lots of people will talk to you about wanting to buy your company, maybe under the right circumstances. Don't get distracted. Just keep building your business. I was very nice to the guy from Yahoo. Went and met with him, told him what we did. Wasn't really worried about him copying it, because why would he? And continued on with our day. So at some point we went out to raise a Series C. We got an offer for a lot of money, and this is a tricky thing. This is what a lot of people screw up. I'm going to talk about this a lot later. We took it. And so we continued on, sold the business, very happy, great outcome with Edify. I stayed 2.5 years after we sold it and continued from there. This is my best advice, and I mean this from all the startups I've ever worked with. Founding and joining a startup to me is a lifestyle decision. It is a shitty way to get rich. It's not a joke. A much better way to get rich is to go be an investment banker, or to go be a consultant, or to go work at a hedge fund. They're still all hard. You probably won't get rich doing any of them, but that's a much better way to get rich. You work around other people whose whole goal is to get rich. There's a set of rules. If you excel at those set of rules, there's a pretty decent chance that you will wind up making lots of money. There's no particular rules building a startup. Some of your greatest successes out there almost were your greatest failures. Everyone has heard the story of basically every company, right? There's a great story about Google getting offered to sell for $750,000, and Sergey and Larry said no, they wanted $1.5 million. And the buyer said no, and there you go. 3 years later, they're worth billions and billions of dollars. There's all of these stories. You will hear them all the time. That's not to say that people get lucky. You need to have a lot of skill. You need to be very smart. You need to work very hard. And you need to get lucky. And so all of those things have to happen. So it's a bad way to do it. It's a lifestyle decision to me where you get to work with amazing folks. You get to try and change the world. Honestly, probably no one will ever use your product, but you get to try and change the world. And to me, this is the best thing. So I made it its own bullet. And I mean this. And I'm even going to show you what I mean in my one graphic in the entire presentation next. Life is too short to work with assholes. The best thing about working in startups is it is the only environment, other than if you're a stay-at-home dad or mom, it's the only environment where you can make sure you do not work with assholes. You get to control your team. This is very important. It's very important for a couple of reasons. One, you want to work with fun people. Your company will be better. Your team will be more productive. But two, you'll be happier. Assume whatever company you go run, you're just going to be running. Probably nothing's going to happen. I imagine if you go look at TechCrunch in 05, 06, 07, look at all those companies that were funded, I imagine the vast majority of them, nothing has happened. They continue to exist. And there are plenty of very happy people that are running their business for 3 years, for 4 years, for 5 years, for 10 years, for 20 years. Some of your greatest successes in history never took venture capital. Work with people you like working with. I get excited. I've worked at or started, like I said, 6 companies, but my 2 co-founders, one I've worked with for 11 years and one I've worked with for 16 or 17 years. I like going to work with them. It's why I didn't go to be a VC or take 9 months off. It's fun. And that's why you guys should be doing this. I don't mean you should do it like it's like going to Europe. You should obviously build a business with the goal that it will be worth plenty of money. You should obviously plan for that. You should take a lot of steps for it. You want to pay back the money to your investors, right? You kind of have a moral obligation to work your ass off to try your hardest to pay back the money. Every dollar you raise, by the way, should not make you feel good. It should make you feel stressed. I raised $8 million for Dynamic Signal on the day we started. I feel stressed. Forget the valuation. I have to return that $8 million to people before I do anything else. Doesn't matter previous successes. That's an obligation everyone should take seriously and think about when you're fundraising. But work with people you like. There are a ton of assholes at IBM, Goldman Sachs, McKinsey, and those are representative of companies, banks, consultants, as I'm sure you can guess. And there's nothing you can do about it when you work in those companies. Maybe you can get transferred. You will have an asshole boss, or you have someone that works for you who's kind of a dick, but they're good at their job. Startups, do not work with people you don't like. Life is far too short, and it is the best career choice for that reason, not because you'll get rich. Just to hammer the point home, by the way, in terms of not selling your company. There's no good data on this. What I did to do this is I talked to 5 different venture funds and I just asked them to give me their data confidentially and munged it together. So everyone can ask me questions about this and argue with it, whatever. It's pretty good data. About 10% of angel deals actually ever raise a venture round. And by the way, that number is going to go down. There's one of the incubators I was speaking at recently, someone had a data point that in the last 2 years, 10,000 deals were angel funded. And about 500 Series A's get done each year. So you do the math. No matter how great you are, there's a, whatever that is, % chance that you'll actually get funded. He says 5, so if he's wrong, talk to him. About 10% of deals will actually raise a venture round. Of those, 60% of those venture rounds don't ever return the money they raised. This is VC data, right? So of those, 30% break even, and 10% make all the money for VCs. So you're really talking about if you start a company, the odds, and obviously if you're really smart, the odds will be better, that's not my point, but there's about a 1% chance that you will ultimately raise an angel round, raise a venture round, and then put $1 back in anyone's pocket. Just to put that in perspective. It's okay, it's great, and it's awesome when it works out. Obviously there's a very wide deviation. Obviously, there are some people that make ridiculous amounts of money and have ridiculous successes, and that's all lovely. But those are the data, and that's 15 years of data. That's not changing. That's in the bubble, out of the bubble, all of that. It's a hard thing to do. Hitting my earlier point, just so you know, this is what an asshole looks like. Very important, do not let them into your company. If you let them into your company, fire them. Treat them well legally, because it can cause a problem later, but do not let them into your company. It is the only thing making your job fun. It is the only thing that can screw your job up and make you wish you just worked at IBM, that has way better benefits. You have to work way less hard. You have plenty of other folks to help you out. The people that work in your company are the only thing that matter. So with all of that, what can you do to improve your odds of having a company that someone might want to buy? Because again, unless you get very big, like Hulu can sell themselves. Hulu can hire a bank and say, we are for sale, and that will work. Until you are that size, you just have to hope that one of these fine gentlemen or ladies that are going to be on the panel next find you and say, you know what? I want to see if this green thing works. I want to give you money. So first of all, make sure you're building a business, not a feature. Everyone says this all the time, and everybody believes that their thing. If you go out and you talk to 30 smart folks in your industry, and they all look at you a little cross-eyed, don't only look at that Pandora blog post about being turned down 500 times. That is the super, super, super outlier. It's an amazing success, but way too many entrepreneurs read that and go, that's proof that when the 30 people I just talked to who know what they're talking about and told me my idea is dumb, that's proof that they're dumb. No, that's not what that means. That's why the Pandora blog post is interesting, because that's the one time the guy got turned down 500 times and turned out to build a billion-dollar business. Mostly, if you talk to smart people and they give you feedback, you should listen to it. Make sure you're building a great team. There's 3 reasons for this. First of all, you'll have a good life. Again, no assholes. You'll have better odds at actually succeeding. And that's the point. The point is not to get someone to buy your business. The point is to build a cool business that succeeds in doing whatever your mission is. And that's what buyers buy. The vast majority of the time, the vast majority of exits are mostly due to the quality of your team, even if you build a real big business. Adify was 100% bought, I would say, in equal parts because we had a great idea, we had extremely happy customers, and we had a great team. Build the best product you can, but this one people don't focus on enough, and just I could have listed 5 slides worth. Make sure you have amazing service. This applies more to B2B. Obviously, with consumer, it's a little bit of a different experience, but make sure you have amazing service. The Zappos case is super famous. Adify one I know very well. AdMeld, DoubleClick, Invite. I focused on ad tech because I've mostly been an ad tech entrepreneur or a B2B enterprise entrepreneur. But if you're getting bought for any real amount of money, the buyer is going to talk to your customers and is going to talk to your prospects. If you don't have the reputation for doing an amazing job with your clients, they're not going to care much about you. If your clients don't feel like you value their business, a lot of clients, this happens all the time, is people think they're going to flip their company. So what do they do to flip their company? They go and try and sign up some pilot customers for a product that doesn't really quite work, hoping that a buyer is going to come along and buy them because they have a slide with a lot of logos. If those logos can't talk about how amazing you are and what promise your product is, you will not get bought unless the buyer is extremely, extremely stupid. Get users, optimize them, understand. Meet a ton of people and explain your vision. I do not believe in stealth. I think stealth is stupid once your product is good. You should meet bankers. Anybody that tells you investment bankers are bad, they're wrong. They're dumb. You should meet analysts. You want the industry to understand what you're doing. Again, your goal is to attract someone to want to buy you. The only way that anyone at AOL Corp Dev or Google Corp Dev or Microsoft Corp Dev has heard of you is if someone in the ecosystem who's talking to them knows what the fuck you do. This is a big issue. I talk to, like I said, I'm an angel investor in about 30 companies, and I talk to people all the time. They say, oh, I don't talk to bankers. Bankers call me. I don't talk to them. Well, bankers are meeting every quarter with the folks at AOL and with the folks at McAfee and the folks at Symantec and the folks at Intel, McAfee, right, and the folks at Google and blah, 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 blah. And you know what they do? They want to look cool. They want to look like they can impress AOL or Google with their knowledge, because all bankers kind of do the same thing, right? So they want to impress AOL, and they want to impress Google with their knowledge. So you say, oh my God, you're really into this. Have you heard of this company? And they're only going to do that and get your name in front of those folks so they go, oh, I haven't heard of that. That's cool. I'll go check them out, which might cause them to want to buy you one day. They will only do that if someone has heard of you. So all these guys that are super secretive, awesome, not going to get bought. This is a big one. People blog about this all the time, and I'm going to talk about this on the next slide. Don't worry about your competitors. Your competitors are not going to kill you. In the early days, you are totally fucked up. Your competitors are totally fucked up. Now, again, if you're worried about a big company copying what you're doing, well, that probably means you're building a feature. If you're worried that a big company, if they hear about what you're doing, can just kill you, you don't have a good business. Right? If your success relies on keeping it secret, it means you don't really have a business. It means it's really easy for Yelp to just go, boom, okay, now we do that too. You're not going to build a business based on a feature. So if you have to keep it super secret, and it's not something in some science field I don't understand, if it's in the tech consumer space and you have to keep it super secret and it doesn't rely on network effects or on having a great sales force and great value proposition, it's not a good company. So don't worry about it. Talk to people. People say this all the time, but companies are far more likely to commit suicide. There was a company, we had the idea for Adify, me, my co-founders, we're all smart guys. We've previously done lots of companies, been very successful. We sit down, we do tons of research, and we have this idea for Adify, and we go, this is great. We're the only people that are doing it. It was awesome. So we go out and we raise $6 or $7 million, I don't remember exactly. And we start selling. And about 2 months in, my co-founder emails me a link, and he goes, hey, Russ, check this out. And I look at it. And it's a page from a company in our space that's been around for 15 years. And it turns out they have a directly competitive product that has been around for 5 years that does everything we hope to do in the next 3 years, right? It's been around forever. And I went, oh, fuck. That's a huge problem. Like, we thought we had this great idea, and it turns out somebody's doing this. But you know what? We didn't worry about it. They sucked at building their business. It turned out it had nothing to do with the technology. It turned out it was all about service and execution. And within a year, I had 150 customers, and they still had their one. So it didn't really matter. We just pretended they didn't exist, because the truth is, that company committed suicide. That company recently got sold, a couple years after Adify, for about 5% of our purchase price. They absolutely should have kicked our butt. But they were really bad at running their business. So it was never really a concern about, ooh, let's keep secret what we're doing. It doesn't matter. Have a great board of directors, have great VCs, have great advisors. They do matter. I think in an early stage, once you raise angel money, I give this advice to people all the time, you want a board. The reason you want it, by the way, by a board, I mean you want a guy. And that guy doesn't have to be someone that tells you what to do. That guy has to be someone that helps you every 6 or 8 weeks, who's disinterested but cares about your business. It's someone you're going to go present to every 8 weeks who knows what the hell you're doing and can call you on your screw-ups and can say, hey, Ian, you said you were going to do these 3 things in the last 6 weeks. You didn't. Why not? Now, maybe your answer is you did something else cool, but why the hell not? And that's a very useful tool. So if you can attract a good board, if you can attract great advisors, that's a good thing for you. I don't buy any of this bullshit. You don't need a board. You don't legally need a board, but you do. You need help. You need advisors. You need VCs. You need guys who are very experienced doing it to help you build your business. And that's a great thing if you can find them. And by the way, ultimately, you do need a financial model. At some point, if anyone's going to buy you for real money, they have to actually believe that your company will generate real money. Talent acquisitions are different. Those are few and far between. So why do companies fail? Like I said, mostly they commit suicide. Can't raise money, can't hire a team. They have a bad team. They have a bad management team. And it's a fun idea, but they didn't actually understand consumer needs. There's a million ideas. It's why I've never started a consumer company. I understand that when they work, they can succeed in a crazy way. But there's a ton of consumer companies that when you hear them, you go, yeah, I could see how that might work or not. No idea. Right? Sounds good, and maybe it'll work, and maybe not. And so if you're into that, just make sure you're testing and testing and testing and understanding, and make sure you're not buying too much of your own bullshit. If you talk to 100 consumers and they don't want your product, and then 500 more and they don't want your product, again, you might be the outlier. You might be the Pandora, but you probably aren't. And you're going to screw up the most important thing, right? You're going to waste your youth. The nice thing now is it's so damn cheap so easy to raise angel money from everybody, suckers like me. And it's so cheap to build a business because Amazon basically lets you build your business for free. You can work in cool offices like this and hang out with fun people. And before you know it, 2 years have gone by and you're still building something you shouldn't have wasted your youth on. You should have just gone to work for another company and gotten some experience. So, okay, someone actually wants to buy you. How do you engage with the buyer? Focus on a business deal. What can they actually do for you? Even a buyer who calls you and says, hi, my name is whatever from Yahoo. I want to buy you. Probably not going to happen. Focus on why Yahoo needs you. Focus on why you can do great things with them and turbocharge them. If they want to buy you, they will say, we want to buy you. They won't be reading between the lines. It's not weird boardroom drama. If you're a small company and they're a big company and you're talking to someone whose title is Corp Dev, that's their job. And if they want to buy you, they will say, hey, Ian, I'd like to buy your company. Would you be interested? Exactly. This is the big one, though, and this was my Yahoo point. Don't get overly distracted about it. You should be professional with the buyers. You should engage with them. If you're interested in selling to them, you should engage with them. You should be open with them. You should make sure that they understand what's going on. You should stick to the process. But you can't freak out. You can't let it mean you push the pause button on your company for 12 weeks or 16 weeks or 2 weeks or whatever. Most of these deals, even after a buyer says they want to buy you, most of the time it doesn't close. For a lot of reasons. You may not want to do it. Whatever the stuff they said might be wrong. The buyer might change their mind. The guy who wants to buy you might quit. That happens all the time. These big companies have a lot of turnover. You thought you were in great with some product group, and the guy that was in love with you doesn't like you anymore. So don't let it screw up your business. Again, because, like I said on the previous slide, you have great advisors, you have great investors, they're going to help you. Just remind yourself that even if you're excited, even if someone offers you a ton of money, you want to deal with it professionally, you want to keep things moving, you don't want the buyer to have to wait, but keep building your business assuming it's not going to work. That doesn't mean be a dick about it. Just assume it's not going to work. I am cursing entirely too much. So I have 2 steps for how you sell your company for a lot of money. Right? Get an offer for a lot of money is step 1. And so I talked about how, but talk to everybody in the space. After a point, stealth is stupidity. Acquirers will likely be strategic, so you have a lot of reasons to talk to them. You're not going to them saying, hey, I'm for sale, buy my company. That's not what you're doing. You're talking to them about the great value that AOL can get in I keep looking at Mike, but you're talking about the great value that Patch can get from your assets, the great value that McAfee can get from the time to market or IP or understanding of a new customer base. You're talking to them about all those great things they can do. They're probably going to want to test things. They're probably going to want to test a distribution deal. They're probably going to want to test an ad deal. So it's worth your time to talk to them anyway. People ask about buying your company. Be honest and open, but not overly eager. My perspective with Yahoo was, cool, great, sure, you can buy us anytime you want. We'll tell you what we do. Don't worry, no rush. We're getting more valuable every month. So whenever you want to make us an offer, that's cool. I'm going to go about the rest of my day. Make sure you're actually building a great business. You think you're an actual great fit. You're going to help them do what they're doing. I already told the Yahoo story. I've got to be more careful with my slides. But again, I'm too repetitive. Talk to everybody. That's the point. And then step 2 is an important one. People fuck this up all the time, and this is the stuff blog about. So again, step 1, get an offer for a lot of money. Step 2, take the offer. Seriously. If you want it. I'm not saying that everybody should sell. There's plenty of good and bad stories about founders that had an offer for a lot of money and chose not to take it. Some of them were happy about that. The Google example with Excite for $1 million. Some of them are unhappy about it. There's a million examples of those too. That's fine. But if you want to sell your company, take the offer and then work very hard with your set of advisors and investors, maybe bankers, maybe investors that have been through it before. It's why it's good to have a board. It's why it's good to have people that have actually been through this before. Have them work with you. Have them actually help you. The smaller the deal, by the way, as much as the advice from before was great, the smaller the deal, you're not going to have multiple parties to play off against each other. When you look at these small deals, sub $40 million that are talent acquisitions, they are almost never done competitively. All the big buyers basically move in and say, listen, we want to buy you. This is how much we think it will be. We're not sure if we're going to do it, but you must sign a lockup. And by the way, if it leaks, we will walk away. So it's great to read a book on game theory about, oh, multiple buyers and let's get multiple parties. That happens if you're building an amazing, amazing company. Anything sub $100 million, you're probably not going to have multiple buyers. That's fine. There's nothing wrong with that. You can worry about the probability of your existing buyer closing and do a lot of things to make sure they close. So I'm not against multiple buyers. Make sure you're being open and transparent. And if you sign a no shop, don't shop your company. There's plenty of stories of deals that died because the big guy said, if it leaks, we're walking away. It did leak, and they walked away. That happens all the time as well. So be careful about that. And leverage resources. Bankers, if you are big enough and you have an investment banker, that's great. If you're too small, generally bankers are just nice guys because, like I said a few slides earlier, you've spent the last year talking to them anyway. They're going to help you out. They're just going to help you out with advice. Why not? They do this all the time. It's a little bit like don't try and out-negotiate your VC on the financial side because their whole job is to negotiate terms and it's not yours. Same thing with bankers. There are M&A bankers and that is what they do. All year long, 365 days a year, they go from deal to deal to deal to deal to deal. They are good at it. You are not. Even if I've done, I don't know, a lot. Some have worked, some haven't. I'm still nowhere near as good at it as any banker who does 1 quarter in an M&A group at Goldman Sachs, something like that. But if you're not big enough to have a banker who's any good, care about you, you still have a lawyer. And your lawyers do deals like this all the time. The top law firms in the Valley have sold 40 deals to Google and to AOL and to Facebook and to Yahoo. They've done these all day long, and they can be great advisors. Do not screw it up by not asking for advice. That is the... I have so many friends that have lost so much money because they thought they would handle it themselves. You will not. I do not. I've done it a bunch of times. I still get help all the time. It is absolutely worth it. That's it. That's my last slide. So, happy to answer questions. That's the taking of the money. So if anyone has questions, I'll happy to ask them. And if not, that's cool too, but. Here you go, Nathan.
Any questions?
Oh, yeah, sure. Go ahead.
So you talked about the lockup period, or basically you're not allowed to shop the deal.
Yeah.
Is that the right time to ask the company to actually sign an NDA, or it's kind of the right song and dance for that? Because it should be...
So from a seller standpoint, the sooner you can get an NDA, the better. Again, for a lot of the really big companies that are buying really small companies, they don't sign NDAs and they don't sign non-solicits, and that's the deal, period. You have no choice. So let's be honest. For most of you, if you're lucky enough to get into the group where you sell, you're going to sell to one of these huge buyers, and they do not negotiate. It's like buying a McDonald's franchise. They have the power, you don't, that's it. But sooner you can get an NDA, the better, of course. Sooner you can get a non-solicit, the better.
And even, sorry,
Sure, yeah.
I mean, even then, they're still going to have your product roadmap, so they can
Yes.
technically still execute on it.
Yes. And you don't have any money to sue them anyway.
Right,
So,
exactly.
and investors, by the way, your angel investors are not okay with you taking their $500,000 and using it to sue Google. Like, they're not okay with that. So, mostly people are good actors. If you see something weird, stop. But mostly people are good actors. Obviously, you hear stories all the time, but it's kind of the risk of being a small startup company. And if you want the chance of being bought, a risk you will take is that the buyer on the other side, who generally have very good reputations, right? All the big buyers in Silicon Valley are really careful with their reputation. They are, because they don't want VCs saying, fuck no, don't talk to Facebook. Like, they don't want that. That's a bad thing for Facebook. But sure, there is a risk. By the way, there's a risk when you interview employees and when you talk to the press. Like, I'm not one of these people who says, oh, there's no risk from sharing. My point is that you are starting a business with the goal of having customers and press and an exit. All of that requires people knowing what you do.
So along the same lines, to what level of detail do you go? So we're now raising a seed, and all of a sudden we've got somebody come out from left field and say, it's a BD guy, saying, we've got some interesting technology, we'd like to talk to you, and then is asking for a whole bunch of information. It could be a big distraction. I'm looking at the list of all the information that they want, and I'm saying, where do I draw the line? I'm curious, I'm really curious. Where do I draw the line?
My guess is, if it's one of the 5 big buyers that buy things, you will. My point is, in general, if they send you a list, you will have to provide that info. Period, because they have the money that you want, right? That was my slide, right? So you would like that, so you're going to have to do it. Mostly, you should worry about the staging of information. Mostly, you should worry about, say, listen, what's a set of stuff I can give you for you to be able to give me a range? It's a non-binding range, that's fine, but what's a set of stuff I can give you so that you can say, look, the number's going to be 10 to 12 million, and I can say, no thank you, or yes please, right? That's what matters more than you're going to give them all the stuff, period.
Tell me more about the strategic. You mentioned strategic investors.
Oh, I just think you should be fully knowledgeable and know what you're getting into. People focus a lot on how strategics are scary, and they don't focus enough on how VCs are scary. The cool thing about strategics is they tend to be very open and honest with you about what they want. They generally are not interested in you building your business as investors. They're generally interested in what they can benefit from watching you build your business and through the operating deal. That's a fine thing. It's a great way for you to raise money on great terms. But you need to understand that their interests and your interests are not the same. When you raise money from a VC, the people that work, everything about that firm is set up to help you succeed, because if you succeed, they succeed. That is not always the case with strategics. That doesn't make them bad people. It makes them, they have a different job, and you should just be mature and understand what that is. But Time Warner Ventures, NBC investors were great investors for me. In previous companies, AT&T, Bell South, US West invested in the company that I did that was based here. Strategics can be really, really good. You have to understand who the strategic is. Is it a strategic that has a real venture arm that tries to act like a VC, or is it a strategic that's just investing kind of off their balance sheet out of their corp dev group? The issue there is, are they going to be around to do pro rata? And that becomes the big issue with strategics is, what happens when you go to do your next round? You found the lead, but between the lead and your existing investors, you still need more money, and Motorola doesn't want to give you any more money because Google just bought them. Like, that's an interesting problem, but that can happen with VC firms too, right? VC firms, they don't get covered a lot, but VC firms die all the time. It actually takes them forever to die, but they become dormant. So you can have problems all the time where you raise money from somebody, and 3 years later that firm's just fucked. And the partner you got money from isn't there anymore. And so the risks with strategic, I don't think, are any different than the risks with anybody.
So last
My buddy, Ian.
Okay, so last year, virtually every panelist said to shop your deal around and get competitive if you can.
Yes, if you can, sure, yeah.
So is that suggesting that those deals that they were talking about were like sub 40? I think you mentioned sub 40.
No, I'm suggesting that that is great academic advice, but in reality you can't. The big buyers that do talent acquisitions have a very fast process entirely set up for you to hurry up. Generally, they're paying nice premiums, and you have to decide whether you want to work at that company or not. But look, it's academic advice. Yes, obviously, shopping your deal around and having a competitive environment when it works is awesome. Obviously, you look at DoubleClick that had a bid at $1 billion, wound up selling for $3 billion, $3.1 billion. That's awesome when that happens, right? That's great. But a lot of times you have the other situation with plenty of other famously public deals where once it leaked, the buyer said, have a nice day. So you have to be careful.
There's a conflict between getting money between when we're at a stage where we got some interest from public companies, got out there and got investment back.
Yep.
Now when we go out there and try to raise money, there are VCs who will just not invest because they think that there is an exit really close by and there isn't enough time for their money to work.
Okay.
So
I mean, it's a high-class problem, but yeah.
So I mean, if you look,
Well, but I would say if you've built a career of being open and transparent with what you're doing, you're either going to say to the VC, listen, we're not going to sell. Or, by the way, VCs do this all the time, right? That's why VCs have participating preferred. VCs will say, listen, I will give you money, but if you're going to sell within a year, it needs to be worth my while. I mean, that's why those things aren't always evil. They are mostly evil, but they started out of legitimate, genuine interest with the VC saying, listen, if I invest at 100 pre and you sell the company next month for $110 million, awesome for you, but I need to make a return on that. And that's fair if you go into that negotiation with your eyes wide open. By the way, in general, I pulled this out accidentally. I had a duplicative slide in there and pulled out the slide I wanted. A very important thing, and it's playing on what one of these guys said, a very important thing is from the minute you start raising money, make sure you have a good relationship with your investors. Don't lie to them. I mean, market to them, right? You lie a little, but don't lie to them in any big way about your intention. Don't lie to them any more than you need to. But that gets paid back in spades when you're getting ready to sell. Because everybody invests in a business thinking it's going to grow like this, right? That's why they do it. Mostly they grow like this, somewhere like that. And if you've been honest and open and transparent with your investors all the way along, they're not going to be pissed at you because they knew up front there was a risk it wasn't going to work out. Right? Every investor thinks they're investing in something that's going to do 10 to 50x, and almost no deals, as we saw, do 10 to 50x. So people know that kind of dissonance exists, and yet people invest all day long.
One more.
Okay? Who has the best question? Okay.
Very short. Who was on your board for Baker Capital?
First of all, I'll tell you, it's public record. First of all, it's a virus. It infects everyone that ever worked there. Do not take any money from them ever. But starting with John Baker, Joe Saviano, Grable, something like that. I don't remember the guy's name. He was short. But no one that ever worked there. No one that's related to them. No one's married. You just don't run away. Kill yourself. Period. That's all.
All right, awesome. Thanks so much. Don't you just want to start a company with Russ? Like, who here wants to start a company with Russ? I do. I know I do. Let's have our panel come up now. The two mics, AOL mic, EA mic. I see you guys. Charles, yes, please come up. And then Dave, I see you too. Hey. Good to see you. Very good. You guys get situated, and in the meantime, we're going to have two very quick announcements from our sponsors, TriNet and Deutsche Bank Private Wealth Management. Do you want to go first? Sure. Okay. Go ahead.
Hello, everybody. Thank you for coming tonight. Great advice that you're hearing out here about focusing on your business, getting great advice from the outside, going to experts in matters where you're not an expert. And that's what TriNet does. TriNet takes care of the business of being an employer, things like payroll, benefits, workers' comps, things that you're probably not too passionate about, but we are. So if you're interested in learning a little bit more, myself or my colleague Daryl's here, but ultimately we help small companies grow and become big companies. So thank you very much for coming.
And David LaPlaca from Deutsche Bank.
Hello. Again, I'd like to thank everybody for coming. My name's David LaPlaca. I'm the managing director with Deutsche Bank Alex Brown in San Francisco. Frankly, I think the advice I've heard so far has been some of the best advice I've heard for startups. But I run two businesses within Deutsche Bank, one being our West Coast Venture Services business, where we consult and advise venture funds themselves. The second business, I run our largest wealth management team on the West Coast, and what our objective is within that business is to consult with technology executives during the entire life cycle, primarily pre-IPO, pre-M&A. So again, there was some early advice that we heard about talking to your advisors prior to any potential deal. I would just tell you that one of the mistakes that we see on our side, which costs people an awful lot of money, is not talking to advisors early in the stage, because once you start getting wrapped up in the process, you don't have time for it. And it can save you an awful lot of money. So anyway, I'm here with a couple of my colleagues, Peter Tortorici, Kelly Morton. We look forward to meeting each of you. Thanks.
All right, so I've got a handful of starter questions here, and then we're going to have about 15, 20 minutes of audience questions. Really awesome panel. We've got two mics on the panel, so I'm going to introduce them as AOL Mike and EA Mike. Mike Smith, AOL Corporate Development. Mike Foley, Electronic Arts Corporate Development. Charles Hudson, Bionic Panda and SoftTech VC. I don't know how you have two jobs, but tell us about that. Sounds pretty cool. And Dave Sabota, Corporate Development at Google. So, rock star panel. I don't know why they're here or how they how it got them to come, but here they are. So let's ask them some questions. AOL, Mike, let's start with you. Let's just start off with a really basic kind of what is startup M&A 101? What are the types of deals? How do you categorize deals? We heard Russ talk about talent acquisitions and strategic deals. Give us just a broad strokes of what you see at AOL.
I'd say it runs the full spectrum, right? So we've done some talent deals, which I'm not a huge supporter of, but I see where they have some value. Mostly, I'm focused on where are the strategic gaps at AOL and what out there in the world kind of can plug that gap. If we can get a deal that actually brings some positive cash flow, that's a huge bonus. So, and those buckets have kind of evolved in terms of their importance, right? So, currently, for example, I'm much more focused on something that's really strategic and helps us out, but also is not going to create more burn at the company.
Interesting. Okay. Anyone else have just a broad swath kind of overview of startup M&A as you see it? Any definitions that we want to throw out to kind of
the larger companies, I worked at Microsoft Corporate Development before, which is obviously one of the much bigger acquirers. EA does, 5 to 10 deals a year as well. A lot of companies just talk about tactical acquisitions, meaning small deals. It's not an insult, just, and the larger transformative deals, which for some companies are $1 billion plus, some are $100 million plus. If you're one of those tactical acquisitions, the company you're dealing with might be doing 20 of those a year. So I think understanding that is important.
Okay, good.
I would just add, we kind of have 3 buckets when I think about it, and talent is an overlay on all 3 buckets, but one is kind of these technology buys where it's an ITA for us, where it's, search is some specific vertical where we don't have the technology and we want to enhance it. Another would be, and these are much less frequent, but traffic or momentum buy. So YouTube, where they just were killing it with, and we had a competing product, Google Videos, it just wasn't. And then the last category for us is kind of a bet on a future project. So Android was that. We bought it as 9 guys, and then it turns out to be growing wild, beyond our wildest dreams. But overlaying all of that is talent. We tend to interview most of the employees of every company we buy, and it's really important for us to make sure that they're going to work well and fit culturally as well as intellectually within the company.
It's an interesting way to. Do you have a quick question?
Just to follow up, do you always sign a non-solicited agreement when you do that?
Sorry?
Do you always sign up a non-solicited agreement?
That's a good question. Google doesn't like to sign non-solicits, and the reason is we have 1,000 recruiters going on LinkedIn every day trying to recruit people from your companies if they're doing a good job. And we actually do, so we don't like to sign them. That said, as we talked about reputation and making, Russ is saying we all want to have a good reputation. If we talk to a company and end up not doing a deal with them, and then I find out 6 months later the CEO of the company calls me and says, Dave, your recruiters are calling my CTO, I will do my best to stop it, just because I don't want to have a reputation of going out there and causing problems. But just our legal group just can't let us sign those as a matter of practice.
Good. Charles, anything to add on that first topic?
No, I think the guys covered everything.
Awesome. So, Dave, I want to stick with you for a minute. Google is the deal machine on this panel. Everyone has been making some interesting deals in the last 18, 24 months, but I think Google's done 20 plus this year, at least according to Crunchbase. A couple big ones, a couple very big ones, everything from Zagat to Motorola Mobility. Talk about the process over at Google, because you're such a machine. How do you go through researching, selecting, and ultimately kind of bringing startups into the fold?
I'm looking over there. There's Tom Duterma, a former Google Corp dev guy who left us to go to Groupon, so our life was made much more difficult because of people like him.
And new business development guy as well.
So our process is really the same as it's been for years. We have a committee of our CEO, Larry, and his top reports who review every M&A deal that comes, regardless of size, even if it's a $1 million talent deal. And we have a standing meeting with them every week, and you present to them. And so before that, we do the things that were talked about at the prior panel and the stuff Russ talked about. We talk to the company, get to know them. And we can talk, I can go into a lot more depth, but deals come from a variety of sources. You need a strong sponsor within the functional unit at Google for a deal to happen. So if I come up with an idea and I think it's the best deal in the world, if I can't find a home for it, where there's going to be someone who's going to own this and integrate it and operate it, it's not going to succeed at Google, and we won't do that deal.
Is that where most ideas originate from that group? Or?
Yeah, I would say 50-50 maybe. I mean, I think if we're doing a good job, and now that we're better staffed after Tom left and hired more people, we're working closely with the functional areas, and we're trying to understand where they see gaps in their roadmap, and we can go out there and help them fill those gaps. But oftentimes they already know the companies out there that they want to take a look at. So
okay, so 50% corp dev, 50% functional or product groups,
yeah. and then 10% top down.
10% top down. Do you have? I don't know if my numerator was right. 20 deals in the last 11 months or so. But what's the denominator there? How many deals are you looking at? What's the top of the funnel look like in that? Do you have any?
Oh, we actually we don't keep good statistics on that. We I meet with 3 to 4 companies a week, it seems like, and we have about 12 people on our team. So, do the math. It's by the end of the year, it's hundreds. So, and then there's probably for each company you meet with, there's others that you get an email on or get a phone call on. So, it's quite a large number.
How many people have emailed Dave just since we've started this panel? Okay, really good. Let's turn it to AOL and EA. Anything you want to add on the process in terms of how you guys either originate deals or get them through the deal pipeline?
It's very, very consistent. The mix for us is varied over time. Sometimes it's very heavily top-down driven, and other times it's business unit driven. And now I would characterize us more in a normal phase, and a lot more of the origination and the idea is going to come out of the corp dev group.
Yeah, I think in part it matters how fast the particular market you're looking at moves. I've found over time that if you're in a space like, for example, some of the newer forms of gaming on, mobile phones or social gaming, etc., which early on moves really quickly. Often the internal folks don't know enough about it. They're not the right source for that. Me and my team spend a lot of time going out and just meeting companies, and it doesn't mean we want to buy you. It just means we want to know what's going on in the market. And it's perfectly fine to talk to a corp dev person. It doesn't have to be this big, heavy conversation. I, equally meet a couple or 3 companies a week. I say the magic words, we want to buy you, pretty rarely. I try and mean it when I say it, as I think all these guys do, because we have reputations. I think in some markets it's a relatively steady pace of change. The internal guys, your executives at the company, can be a great source of knowing what's going on. In some markets, frankly, they're just not.
Interesting. Okay, good. But EA, you've done a few very strategic deals recently. I imagine a lot of that's coming top down. You're kind of making some.
Yeah, if you're, a company of our size, which in this context is relatively small, doing $1 billion deal, that doesn't come out of me going out there and going, hey, wow, there's this company out there, we should buy them. It tends to come from a relatively longer term relationship. We, for example, with the PopCap transaction that we closed recently, they've been around for 10 years and we've known them for 10 years. We have had M&A discussions on and off several times prior to this one happening, and that's quite common for the bigger transactions. So, the timing might not be right for them, or it might not be right for us, but eventually it came together and it was right for both of us. So in the bigger deals, that takes a whole different ball game of getting our board involved and our senior executives across the company on board with the deal. That's a different. The smaller, again, the sort of tactical smaller transactions. Different ballgame. They can often come in and happen really quickly.
Good. Charles, we haven't heard you speak yet. Let's hear from you. You've been in a startup, serious business that was acquired by Zynga.
Yep.
I have not been able to land a Zynga guy on this panel yet. So give us a little peek inside the Zynga machine, which is also a really active M&A shop. There's a lot of perceptions out there about what it's like to sell your company to Zynga. What can you tell us about
I mean,
it?
I would say anytime you're dealing with someone who does a lot more deals than you do, so as an entrepreneur, I think one of the things that Russ said that really resonated is, as an entrepreneur, you'll do 1, maybe 2 deals in your life if you're really good. The Zynga Corp Dev guys, I think, have done 14 announced transactions in 12 months of varying size. Everything from New Toy, which was a pretty functional company, not a lot of people, but pretty functional, to teams of 2 or 3 people who leave shortly after. I won't say too much specific about Zynga. It was a year and a half ago. I don't really know all the specifics of what they're doing now. I will tell you the things I've seen consistently trip up entrepreneurs when you're dealing with a more experienced or aggressive acquirer. And I would say anyone who knows Zynga knows that their culture is very aggressive, and you can imagine that translates to M&A. One of the biggest things I see people get wrong is just every deal has rhythm. Whether it's a corp dev deal or a biz dev deal or any kind of transaction has a rhythm to it. And one of the most important things is managing your own emotions and expectations about where you are in the process. So a lot of times, I advise a lot of companies. I have some where we're investors, and as an investor, you get this call sometimes. Oh my gosh, we had a great meeting with Google. It was awesome. I think they're going to buy us. You're like, okay, well, who was there? And they'll say, this guy was there. All right. Well, what did you talk about? We talked about this. Did anyone talk about price? No. What are the next steps? I'm not sure. Oh, I guess we're not really as far along as we thought. And so I think one thing to do, especially when you're dealing with people who do lots of deals, they see 12, 15, 20 emotional profiles. And a lot of times they're going to try to figure out what kind of person you are. Are you an impatient person? Are you a person who gets nervous with silence? Are you the kind of person who's going to push, who's going to freak out? So a lot of the process of selling your company is as much about you getting to understand the culture of the place you're going to join and how they do business, as much as it is about them learning whether you're going to be a fit. So I will tell you this. Most people I know who've dealt with the Zynga M&A process, whether they were acquired or not, it's contentious. They don't like to pay a lot of money for companies, and for a long time, they were one of the only, if not the only, acquirer for small social game studios, and they knew it. That doesn't mean you don't have any leverage as an entrepreneur, but you have to go in understanding kind of, hey, they're a really big company, they're growing really fast, they have endless access to private capital. I'm a 12-person, 20-person, 5-person studio. Realistically, what's the leverage difference? But what levers do I have that I can still use? Because obviously we wouldn't be having this conversation if there wasn't interest in having us join.
Did you have a banker on that deal? Or did you guys use
We had the fortune of having a chairman who had recently sold a company to Microsoft, who I think was really experienced. And so he gave us a lot of counsel. We talked to some bankers, and we sort of talked to them about the range, and they're like, we can help you out with this if you want. And we ultimately decided that our investors, we also had someone from Lightspeed who's been involved in a lot of transactions. So we felt like we had pretty good insight. And to Russ's point about sort of shopping your deal, there were only a really finite number of companies where A, we knew that they had the money, and B, where, frankly, the founders thought there was a cultural fit.
Yeah.
And so it wasn't one of those things where we can go, they'll tell you, hey, we can go get you, we can take your deck to 60 companies. There's 4 who care.
Yeah.
Like, you can go talk to 56 others, but we knew there's 4 that care. And we knew those guys because we had relationships with them before, so it was very easy to go to them and say, hey, this is what we're thinking about doing.
Interesting. Cool. So EA, Mike, is this an opportunity for EA to be the nice guys if Zynga's the contentious, aggressive guys?
I'm not going to bite. We are the nice guys.
You're the nice guys.
Yeah, we always were them. No. Look, I think the advice there of do some reverse due diligence is great advice. Every meeting, if I meet a company, one of the key things that we talk about after the meeting is, did you like those guys? Were they a good fit? Do you think they would do well at EA? What do you think the culture is like at their company? If they're talking about, hey, you know what, we just crush it every night. We're here 7 days a week. We just freaking love that. Our guys are just pounded. I come out of that meeting going, I don't think you're going to fit well at EA. I mean, those guys work hard. We don't do that. So, I can think of a couple of other companies you might like, but EA probably isn't your one. And you know what? If it isn't going to work, we don't want to buy you. And, we really don't. Please go somewhere else. Sometimes, you sort of get into momentum on a deal, but that aspect of it, not the numbers, not the model, not the this, that, and the other, strategic fit, blah, blah. If it doesn't feel right in those meetings, then it's not going to work, in my experience. And Playfish and PopCap are two examples of the biggest factor in those deals happening was violent, just kind of liking each other, and it really
like each other.
Yeah, it just works. It feels right, and you're sort of talking the same language, and you feel like the people are the same type of people. That's just really important. And if you're in the room on the other side, don't get too excited about the deal if it doesn't feel right, because ultimately it ain't going to work, or something's going to, people are going to be looking for a reason not to do it if there isn't a good fit. And you're going to know that. So I would encourage you to do your reverse due diligence on whoever you're talking to, if it's multiple companies, and factor in a big way whether there's really a fit there.
So we have to pass that question over to AOL Mike, because I think that's a natural tee-up, right? The violent liking the people. You had to know Michael Arrington was going to be a handful when you were looking at that company. I mean, you could almost see where that would pan out, but it's a very great property. Like, how do you almost do what EA Mike is talking about, in a situation like that? Can you? I know it's kind of a loaded question, but
it really is. Our whole approach with TechCrunch, we knew going in that we need to kind of let these guys do what they do, right? That was the value, and that was going to keep the business on course, and that we could bring some value in terms of traffic, monetization, and those sorts of things. Candidly, the deal has worked out quite well for us, the recent stuff notwithstanding. At the end of the day, am I glad the way things all kind of panned out? No, not really. But we knew that Michael Arrington is a bit of a handful. But it's like managing talent. How do you manage talent? He gets into a beef with our Engadget guys. Does that hurt us? Maybe reputationally, but is it driving a whole boatload of traffic to our sites?
Right.
Absolutely. I don't even know how to really measure that, right? Cost benefit analysis. But the points are the right points. There has to be a fit. There has to be a shared vision. It's critical in every deal. Talent acquisitions, like I said, different category.
Good. Anything else to add? That end of the table on?
I was just going to add one more process point, and this is something that was one of the biggest surprises. And I don't know how the gentleman on the panel handled it, but with a lot of now that I've seen a few of these, is the disproportionate amount of time spent with founders and senior management versus the rest of your company during M&A processes. In terms of figuring out, in most of the deals I've been involved with, pretty early on, the acquirer figures out these are the 10 people we got to have. We got to make sure that these 10 people are really excited. They really want to be here for X number of years. And everyone else, we want those guys and those gals too, but it really is about making these 10 people happy. And if you have investors, it's usually making the investors happy enough to go along. But frankly, the investors are not going to show up for a day of work at the acquired entity. So it's really, who are the people who are sort of the core of the business? How do we, not isolate, but how do we really focus on the needs of that small core group and get them fired up? And it's their job to sort of get everybody else in the company as excited about the deal as we hope they are.
Yeah, they're the glue.
They're the glue.
Right.
Interesting. So, all right, we've talked about culture, we've talked about fit. Let's assume there's the violent likability, I love that phrase, happening on both sides of the table. Dave, maybe I'll go with you on this question. There's always curiosity, intrigue about how does valuation happen in these deals. You guys must have some frameworks for that. I know every deal is going to vary, but what should people in the audience sort of
Well,
expect?
some art and some science. So when they're a lot of times when we're buying pre-revenue companies, so if you have a revenue-making company, especially if they're kicking off profit, those are the easiest because then you can do your discounted cash flows, you can do your multiple analysis, you can look at comps. But a lot of companies that we buy, and I think other folks on this table buy, are either pre-revenue or certainly pre-profitable. And those, it's you look at the projections for the next 5 years, and they're always up and to the right. And if you do the discounted cash flows, it's 10 times more than anyone would ever pay for the company. So you look at intangibles, you look at things like the quality of the talent, you look at how long it would take us to build this, and realistically, are we ever going to build it because we're going to need to hire 20 great engineers who don't know anything about this, and then how important strategically is it? So you kind of come to a range internally you think makes sense, and then you start having the dialogue and see if you can get a deal done in that range, and if you can, great, and if not, then you go on to the next one.
Is there any truth to the metric of, what is it, $1.5 million or 2 million per engineer?
It's $500,000 actually is the current.
$500,000 per engineer, crushing down your hopes. And
honestly, that is a metric you sometimes. I don't like it. It's silly to put, and oftentimes when people are doing that metric, they're not looking at, is this guy fresh out of CS school, or has he been doing this for 20 years? And so there's not even the refinement that really should be applied if you're going to do that analysis.
Sure.
But if there is nothing else, that is a metric that people look to. So.
Interesting. Maybe stick with EA, Mike, on this, because PopCap was a pretty rich valuation. Let's talk about both valuation and structure, because if I have my numbers right, it was $1 billion plus, but it had a pretty healthy earnout, some stock. I mean, how do you go about setting a deal where it's a company that's got some momentum? It's not just a talent acquisition.
Yeah, definitely not. So the PopCap transaction in particular was up there with as complex an outcome as you can get, and obviously a heavily negotiated agreement. It's not my preference to get into complexity. It's not necessarily by choice, but look, first of all, that was a competitive transaction. They're the best company at what they do in their space. We know them better than anybody else, and we understood their potential, the potential of their IP and the potential of their team. First of all, I think we just saw a lot there, and there's a lot for them to do to justify that deal, and they're up for doing that. And part of them being motivated is that a considerable part of the value is based on future performance, and that we call that an earnout in the transaction, and basically they have to hit certain targets, certain profit targets to get a considerable portion of the purchase price over the next couple of years. There's pros and cons in structuring a deal that way. I think certain industries and certain types of companies, it's very challenging to have an earnout as part of the structure, and I would advise against it. In certain industries and companies, it is very possible to do it, and it not only bridges the gap in valuation expectations, but creates this great incentive for the management team to really drive the business and grow it for the next couple of years to meet the targets that we want them to meet to justify the overall price of the deal. So if we're paying an earnout, as with Playfish and PopCap and some of our other transactions, we're really happy because that means it's worked. If we're not paying it, we're really unhappy, and that's sort of counterintuitive in some ways, but that's the reality.
AOL and Google, are most of your deals come with an earnout, or is it beyond a certain threshold in valuation that it's earnout territory?
I wish there was a specific formula. I think we're kind of rethinking that whole concept. Earnouts, when they go well, they go great, and when they don't, everybody's fighting and suing, and it's really an ugly situation. We've tried various formulations of it. I don't think that there's a great answer. I mean, it's something that works very well in theory and sometimes works, but it doesn't work a lot of times as well, and that creates headaches for everybody.
Okay.
Google's experience is we were really hot on earnouts. I started Google about 6.5 years ago. We were really hot on earnouts, did them for every deal for a while, and now we never do them for any deals. And for the reasons these guys said, I think, if you're buying a company that can be independently run and operated after you buy it, with no input from the acquirer, that's a company you can put some earnouts on and measure it independently. But if you're scrambling eggs, it's really hard to say whether the success or failure was their fault or the acquirer's fault. And that's what we found. So it was it's great in theory, but we just found they didn't work that well in practice, and they always had to be renegotiated and sometimes led to disputes. What we've done instead now is we give the employees who arrive at Google time-based vesting. So it's additional compensation on top of their normal hiring package. It just every year they get a slug of dollars or restricted stock units, and we found that to work out really well. The risk, of course, is that people are going to rest and vest, but if we're doing our job right and buying companies with highly motivated engineers and entrepreneurs and product guys and business guys, they're going to want to continue what they've done before at Google. And so we really haven't found that. We found it to be a really elegant solution for us, anyway.
Cool. Charles, any commentary? Did you have?
Yeah, I'll just say from the entrepreneur side, the scary thing about earnouts is if you don't have a stable business, or especially if you're in an emerging or speculative area, or you're a small team, the odds are high that in a year what you're working on won't be cool anymore. And if your earnout is tied to the performance of what you were doing before, or some speculative project that, for whatever reason, hits the wall, you can find yourself. Which is why I think the time-based vesting makes more sense. I've seen a couple of transactions where the earnout incentive trumped the incentive to collaborate and do what was in the best interest of the parent company, even though you're in the same company. And the entrepreneur decided, all I care about is maximizing this earnout. Also because it was a large chunk of the deal. Yeah. And that's really disruptive when you end up with a company inside of a company, which you can sometimes have. So I think as an entrepreneur, if you have a business that's got a good run rate, and to Dave's point, feels like it's going to continue on, you're going to get support, you've got resources, it can be reasonable. If not, if you're like, hey, we're building out this new area, we think you guys could be a foundational component, big companies cancel projects all the time. They cancel products, they shuffle people around. You could end up in a totally different group and say, wow, I'm happy to be working on this new thing, but my comp has nothing to do with this new thing. It's all tied to the old thing. So just be careful about that.
Yeah, I think we could spend an entire session on kind of why deals fail after acquisition, and there'd be some really interesting topics on that. Maybe we'll keep moving. I always need to ask the outlook for 2012 question. Maybe Dave, I'll start with you. Motorola Mobility to Zagat's and everything in between. What's on your shopping list for the next 12 months?
Yeah, if I had been here 12 months ago, I wouldn't have said Motorola, so it's a bit hard to predict. But I can say that we'll do a lot of deals, and I actually think we, notwithstanding your prelude there, we're being really focused, more so this year than in prior years, on what we're buying and trying to make sure they're core and have a real strategic fit. And so I see a lot of deals. And in terms of people always say, what's hot for Google? The way to answer that question is look at what Google's talking about. What are we announcing? Social, YouTube, display, commerce, and payments, things that we're talking about publicly. Those are areas of focus for us, and those are areas that M&A can play a role in helping satisfy corporate strategies.
Interesting. Yeah, what would plug into Google Plus to keep people coming back a lot?
And we've done some acquisitions. So for us, a lot of it is getting an injection of people who live and breathe and have scar tissue and understand social and understand virality, something that Google historically is not good at. Google's core, and we're getting a lot better at this, is creating great algorithms. And if you build it, they will come. And socials, it takes a lot more art than that. And so, trying to get some of that DNA into our system is a big part of some of the acquisitions we've done there.
All right, EA, Mike, same question. EA has historically been very strong in console games. It seems like you're making kind of the Battleship is pivoting into more mobile and casual and things like that. Is that going to continue, or are you satisfied with PopCap and Playfish? Have you swallowed what you needed to swallow there?
Well, I mean, the great thing about working in the game industry is that it's the pace of change is accelerating. It's not even, it really does change at a mind-blowing pace, which gives me a job. It's great because we continually need new capabilities, and not only do the platforms continually change, Google comes along, but also the business models are changing, and that takes a different set of people and capabilities often to be able to adapt to that. So the pace of change feels like it's accelerating actually, which is really exciting, but requires us to continually do more M&A. Now, are we going to do several billion-dollar deals? Probably not. But we're definitely going to continue to do some of the smaller transactions that bring in that capability, whether it's sort of in various sort of niches or capability sets in mobile, social, and other areas. So we're definitely continuing to do a lot of transactions. We closed 4 deals in the last 4 months, which 3 years ago we'd be doing 4 deals in 2 years. So the M&A sort of pace and cadence is pretty high for us just now, and we're going to continue to look at things as they come along and try and keep the ship turning towards this cross-platform, multi-platform capability that we need.
Do you anticipate, I know with public company and everything, but do you anticipate more indie game developer acquisitions, smaller game developer acquisitions? Is that on the horizon?
Yeah.
Yeah. Any numbers?
No, I don't predict numbers of transactions for the same reason Dave said. We'll continue to look at our typical cadence is sort of 5, 7, 10 deals a year. I don't know if we'll continue at that. They can be anything from a $2 million deal to a $1.3 billion deal on the larger end for us. Most of them will obviously be at the smaller end, but we're continuing to meet lots of companies and stuff going on right now, and we're definitely going to be firing at it. Absolutely.
Cool. So I think there's a few gaming guys in the room. I was hoping to give them a little carrot in front of the
there you go.
the long nights. AOL, same question. Where are you guys going to be buying in the next year? You've done interesting deals this past year.
Yeah, I would say local. So patch monetization is a big focal point for us. Distribution, so other content-related deals that we can kind of extend our tentacles out even further. And mobile is actually going to be something that's real complementary to us, but probably not in the way that most people would immediately think. I mean, mobile for us really is a distribution channel, and that's how we're thinking about it. And so we want things that are going to be complementary to our media business in that regard, but could take a variety of forms, right? Ranging from, I wouldn't go so far as to say casual gaming, but maybe commerce-oriented or things that help kind of extend out our reach from a patch perspective, for example.
Cool. So one last question, Charles. I'll throw this one at you, and then we'll open it up for audience questions. So be thinking of your really clever questions. Charles, you've been sort of the entrepreneur advocate on the panel since you were involved in Serious Business's acquisition by Zynga. Now you're a VC. So has it changed your thinking about exits? You have portfolio companies, they need to make you guys and your LPs money. Are you involved in setting sort of exit strategy for some startups? Or?
Yeah, so I do. It's weird. I have one of these jobs where I do both every day. So I try not to give our companies advice I wouldn't take myself. I think the one thing is, as an investor, ultimately, like companies get to where they get. I know that sounds like a really weird statement to say. You can have a company that you're really excited about, and for whatever reason it doesn't execute. You have to be proactive and sort of take the bull by the horns, because sometimes if you don't, the entrepreneur will do what all entrepreneurs do, which is keep pushing forward. And so I think the thing you have to be sensitive about as an investor is knowing when you can sort of pull the entrepreneur aside and say, listen, you're doing everything you're supposed to be doing, but this business, it just isn't working. You're not hitting the Series A metrics that we would need. We do primarily seed deals, so it's not an easy conversation, but it's a conversation that shouldn't be a surprise to the entrepreneur. So if we've been doing a good job as an investor, everyone's kind of on the same page about what the metrics probably need to look like in any environment to be a good candidate for a Series A. And when they don't, we try to be really honest with companies. We're like, listen, you're probably not a great candidate. We will support you if that's what you want to do, but we really should start thinking about an M&A process and do it before you have 6 weeks of cash left, let's start that process earlier. And it's not a fun conversation because everyone doesn't always agree.
Yeah.
Sometimes the entrepreneur is like, I disagree. I think the next release is going to be the one that turns traffic from this to this, and you'll see in 3 months. And sometimes they're right. A lot of times they're not.
A follow-on to that, as a seed investor, what's more appealing to you? The startup that has aspirations of raising multiple VC rounds and going for big, or taking your money and selling to Google for moderate exit?
I think there's this illusion sometimes for entrepreneurs that the preference functions for these folks are stable and predictable. That if I start a company today, because Google cares about local right now, in a year, the thing I'm doing is going to be a perfect tuck-in acquisition. Well, the world changes. So the thing, if you wanted to do that today, you probably should have started that company 12 or 18 months ago, when it would have been less sexy. So I think there's sometimes this. So the thing that makes us nervous is someone says this is going to be a perfect, and Russ I think hit the nail on the head. This is going to end up being a perfect feature complement. Like we're going to put this little piece of Chrome on YouTube, or we're going to put this little piece of Chrome on Gmail, and it's going to be awesome. Those companies never end up becoming big or interesting, either to us or oftentimes to the acquirer, because then it's really like, oh, this is a feature, it's an add-on. We could do that, or we tried it and it didn't work, whatever it might be. So we're looking for people who are building things that feel big. We don't expect you to have everything figured out, but there is kind of a minimum scale, and we're seed investors, so we expect to get diluted down over time. So it has to be something that feels like it can be big, so that our eventually small stake ends up being worth something meaningful.
I like it. I really love that phrase. Did you just come up with that on the fly? That the illusion that preference functions of the acquirers are stable and predictable?
I studied economics in college, so I tend to say weird things like that.
Let's have a few audience questions, and I'll repeat the question just so the mics can pick it up. You, sir. Yes.
So
John.
we've heard about what percentage of companies actually ever get bought, but after the transaction closes, what percentage of the transactions would you say actually worked, and the ones that don't, why did they fail?
The question is, what percent worked and the ones that failed, why did they fail? It's a really good question.
The first answer is 66 2/3% for us, and no, actually, we've done some. We think it's around 2/3 for us, and
succeed.
That succeed.
Yeah.
And with a subjective definition of success, obviously, but the reasons they fail, and actually I think that's really high, and you don't want much higher than that because then you're not taking enough risk. And I'll say overall that we certainly believe that as a portfolio, our M&A has really paid off. You look at a lot of the top products that we have, their genesis was M&A. But for us, why they fail is we didn't have a clear strategic vision. It was maybe where instead of like talking to a functional area and saying what's your product roadmap for the next 2 years and how can we help fulfill it, someone sees a bright shiny object and say, oh, I want to buy that. And then so that's thing number one. Thing number two is not having a real good owner at Google. So it comes on to Google and it's this appendage, and no one really manages the team, no one integrates the team, no one shows them how to succeed, and then so it just kind of falls away. And then maybe a third would be is if we didn't diligence the team well enough, and there just wasn't that fit that we thought there was going to be. Those are probably the top three reasons I can think of.
AOL, Mike. I mean, AOL's interesting. You had a few mulligans here over the years.
Yeah, it depends on the time period you're talking about, right?
Yeah.
Our recent track record, I would say, is pretty good, probably on the order of 66 2/3. But historically, we've had some big flameouts. But I would put that squarely on, the revolving door. I've been at AOL for 7 years, third management regime, right? And it's the same story. Everybody comes in, lots of cash flow, let's buy, and everything everybody else did previous to my arrival was enormously stupid. So it's a very interesting phenomenon, but the reasons are the same, right? So you bring in a team, and either they were the shiny object that then loses its luster, or the priorities shift as a company by virtue of a revolving door in terms of management, or the deal sponsor who was, had to have this thing is, gone 6 months after the deal takes place. So all of those things happen. So, all of the items that we've discussed, the fit and the, how well it fills a gap, all that stuff is really super important, but the world changes, and sometimes in a way that makes the shiny new object suddenly obsolete.
That's good. Can we talk about, on failure, just one quick point, maybe, what's the most common reason deals unravel prior to closing? Maybe just go down the line. Like, where does it usually fall apart before the check clears?
A late stage deal, the one I'd point out that, I think somebody in the first panel said that we very commonly cut the price on our deals late. That's not my experience. The one time I've done that in the 30-something deals I've done was because Russ's great advice. They concentrated on the deal. The company revenues fell off a cliff. They weren't focused on running the business. Their reasoning was, we were so busy working on the transaction. Sorry, that's not okay. It's just not. So if your business falls apart while you're doing the deal, something's going to happen. Either the company's going to walk away or we're going to change the price. And that's entirely justified in my view.
Dave, any common pattern why, a few of the, Gig or Groupon or any of the deals that kind of got pushed away or slipped away? Any patterns in?
Yeah, I would say that it depends what you're talking about. Once we sign a term sheet, there's a really, really, really high certainty of close. And so if you're talking about before then, negotiations can break apart for 1,000 reasons. Some of the stuff Russ said, we have a high allergic reaction to deals leaking, and we'll walk if we find out that it's due to the other side. You need to build up, I think, Charles, you were talking about the kind of the rapport and the rhythm of a deal. If you've got a good rhythm going and then you find out that you've been misled or lied to or something like that can derail things really, really quickly. There's obviously an element of salesmanship in any deal, so there's that, excluding that, but if you're kind of beyond the bounds of that. Generally, I think we pride ourselves on having a high degree of certainty to close. We do a lot of diligence up front, and so we're not going to sign a term sheet. And, even though the term sheet says it's non-binding, other than the no-shop provisions, we pride ourselves on that being a real firm handshake and getting to closure most of the time.
Yeah, we have a really high close rate as well. So once we get to an LOI, it's pretty certain that we're going to get to the finish line. But beforehand, it really does boil down to, is everybody shooting straight? Are we finding out things that end up being really toxic? And some of the points earlier on were really good as relates to IP and employee classifications and those sorts of things, where while they may not matter to a young early stage company, to a larger company, particularly as relates to potential infringements, big deal, right? We have deeper pockets and people are just going to come out of the woodwork and start suing. So those things really do matter to us. But as long as the financials follow on target and there are no undue surprises, we're going to get it to the finish line.
Cool. Yes, sir.
Yeah, as part of the entrepreneur doing the reverse diligence, what would you say going into the engagement are the top 3 questions they should ask you?
The question is, what should the entrepreneur be asking the acquirers?
I'll give you one question, which is if, and back to the some of the points made earlier. If someone is saying we want to buy you, or here's a price, or having that discussion, and you want to know if it's real, ask them who signed off on this. Is your CEO? Have you met your CEO on this? Because you can be sure they haven't got authority to sign anything with you unless their CEO is behind it. So if you want to know if you're in a real conversation, it doesn't have to be on day one. We're talking about down the line, hold our feet to the fire about our commitment, just as we'll hold yours to your commitment.
I like it. Let's keep with this. What else you got? Charles?
Charles should answer this.
I would say if you don't know who your advocate is and you don't have one, I can pretty much assure you your deal will not get done. So the thing I always try to figure out is who's the person whose P&L's on the line, who's the person who's fired up to have my company or the company I'm working with join. And do I like that person? And when do I get to meet him? You don't want it to be the man behind the curtain. Oh, we have a product owner who's really interested in what you're doing. Like, who is it? Oh, he's an executive in this division. Okay, can I meet the person? He's really busy right now. We're kind of kick the tires a little bit and figure out what you guys are doing. That's BS. The sooner you can meet that person, because you need to size that person up yourself. Do I want to work with this person? Do I think they're serious? And then you can start back channeling, hey, does this person have the pull? Not everyone in a big company has the pull to say, I want that, go get it for me. Some people, they'll say, you want that? That's really nice. But the last 3 things you've done, or you don't have the juice, whatever it might be, you need to figure out the landscape. As a startup, you need to figure out the landscape of the acquirer. How do the deals get done? Where do they fall apart? Who's the person in legal that you do want to work with? Who's the person in legal you don't want to work with? There's all these little minor things you need to start building your own kind of picture. And the sooner you can start that, the better.
Dave, what do you get asked? What are the tough questions?
I think that's great advice. I mean, figure out, if I were an entrepreneur, I'd want to know where I'm going to reside in the organization, who my boss is going to be, what my role is going to be. I mean, when we do acquisitions at Google, we want them to view this as not a 6-month and then out. We want this to be 3-4+ years. And so, make sure you're going to be, it's a job interview from your perspective. Make sure this is a company you want to work for, it's a group you want to work for. And then also, I think, Charles, understand the process, understand where you are in the process, understand what's going to happen, what needs to happen, and so you can just, it's good for us too. The worst thing I can do when I'm managing a deal is have the entrepreneur on the other side not understand where they are, and then there's expectations that are missed. So communicate a lot on process. We're happy to tell you.
Yeah, I'd just echo everything that this group has already said. Finding and making sure you have that connection with your soon-to-be boss is absolutely the critical piece. The almost non-answer in all of this is figure out how much juice your boss is going to have. I mean, but it's a real exercise, and I don't have great advice as to how to suss that out, other than if you can have a strong connection in terms of shared vision for what you're doing, likability, or I forgot what the
violent
likability. Yeah, it's a great one. That's critical. And if you can assess whether this guy has the juice to keep you viable, then I think that's really the important stuff.
Great. Hetty.
Actually, more for Dave. With the ITA buyout, it was so heavily publicised. Was it something that there was maybe, or maybe you can't discuss 100%, but a bit more of a shaky ground system? Did you expect it to take so long? And does anybody else have any really hefty success stories?
So ITA went through regulatory review for Google. It's no secret that the regulators are looking at our business in detail, and we welcome that. We understand that, given our size and stature, that we're gonna get that review, and we're just real happy that that deal closed. We think it's best for users. I think there's gonna be some great innovation coming out of that.
Okay. Yes, sir. Glenn.
What are the things that you try to make sure you actually get nailed down into the term sheet part of it? So, purchase price, but all the other pieces, how far down the path do you try to get negotiated into agreement before you actually move past the LOI?
The question is, what other pieces beyond price do you need to kind of come to an agreement on before putting down a term sheet? Is that right?
Yeah. I would say from my perspective, I don't want to waste a lot of time on an LOI. I don't want to negotiate it and then get into the deal docs and renegotiate it, because invariably that's what happens. Everybody thinks they understand that, I want to talk about escrow and I want to talk about indemnification, and these are the key pieces that I think I want. And then when they see those pieces in the context of all of the deal documents, maybe not. And certainly I don't want to negotiate any kind of recourse provisions until I have a full picture of what's going on. And I don't yet at the LOI phase. So for me, simple is better, right? I want to make clear, here's what we're prepared to pay, here's how that will work if there's an earn-out or some other sort of feature, and make real clear that I want the employees sticking around for as long as possible, indefinitely, ideally.
Yep. Good. Yes, sir.
Since it takes two to tango in this process,
What are things that startups can do to be better dance partners?
I like the way you phrase it. Two to tango, what can startups do to be better dance partners?
I think Russ's advice in the prior panel was great. I mean, we do, for example, we talk to a lot of companies that statistically we're not going to buy, and be cognizant of that. But if you've got time, it's worth your while to talk to the folks on this panel, because, if I don't buy you, I've got Tom over there at Groupon who might. So it's good to keep an open dialogue and keep your expectations real.
I guess I would say go into the conversation knowing what you want to get out of it. Some people, I think this is human nature. I think some people say, I'll go talk to Google because they called me, and they throw out a $25 million number at some point, and suddenly what was going to be informational, you're thinking, man, $25 million, I own 40% of the company now. And suddenly your perspective on selling your business can be influenced by the process. It's emotional. I mean, all entrepreneurs know it's emotional to talk about selling your business. And sometimes I think people can get reeled in a little bit. You have one conversation, you come back, you meet a few people, and you went in saying, we're not really interested in selling. And next thing you know, you've been over there every Wednesday for 4 weeks in a row, and suddenly the idea of selling becomes more comfortable. Or if you'd said, hey, we're going to go have one meeting, then we're going to stop, we're going to regroup internally and figure out whether it makes sense to tell these guys anything more than that, you can really get kind of seduced by the process.
Yeah, I'm going to say something slightly different to that. As you can, what a shock. I don't think you're going to choose when to sell your company. I think the market's going to choose when your company gets acquired. That's mostly the case. There's a sort of logical dissonance here where people want to sell their company when it feels like the right time, which is usually when things aren't starting to go so well. And people don't want to sell their company when things are going great. Well, you're only going to get bought when things are going great. So don't fall into the trap of thinking, you know what, we'll just hang on. Now, there's exceptions to that, as has been said, absolutely. Facebook was a good example. They didn't sell for $1 billion. I remember thinking at the time, wow, they're crazy. Well, I was wrong, they were right. But I think there's far more examples of the opposite, where people hang on and maybe they shouldn't have. Just understand that you're sitting there thinking, you know what, I think I'm going to sell my company 2 years in March is total nonsense. It really is. It's going to, the market conditions are going to be right where, or not, but if it happens, it's going to be because market conditions are right and you've done the right things and you've become visible to guys like these in the panel and other people, and it all kind of comes together. It's not necessarily or unlikely to be because you decided, you know what, it's time for me to sell.
So, just real quick, to be a good dance partner, right? Be pragmatic and be a straight shooter. I mean, I know you're going to be kind of a salesman as you're in there talking about selling your company, and you should be, but if you can be pragmatic and a straight shooter, then no problems.
Awesome. How about, let's keep going with it. Audience questions. Yes, sir.
So,
maybe two more.
As an entrepreneur raising money, you often get the advice that you shouldn't just cold call or approach a VC directly. You should try to get an introduction or have them hear about you somehow. I'm wondering if that applies when it comes to M&A as well. In other words, anybody who comes up to you at a panel like this, are you really discounting them?
In the next 10 minutes.
That's awesome. Or is it just, don't worry about it, build your business and, you'll be fine.
The question basically is does the means of introduction matter? Essentially,
I enjoy all your company, but I'm here on business. I'm here to meet you guys. So I want to meet people in the industry. It's not going to be, if you come up and say, hey, you know what, I really want you to buy my company, that is telling me that you've never been through this before and you don't know what you're doing. I think you want to come up and say, I'd love to tell you about my company. And I'm all ears.
But what is the best approach? I mean, there's one, cliche in the VC world. You go to VC, ask for advice, you get funding, and vice versa. What is the sort of best approach to get into the acquirers? Is it through a biz dev relationship? Is it through a product? Is it through just being a sexy company? Is there a...
But I think what Mike said earlier about how, companies don't sell themselves to get bought. I think for that to happen, at least at Google, a good way to get your company bought is develop relationships within Google, not just within corp dev, but probably more importantly within the product organization. Make yourself known. If you can do a commercial deal with Google so that there's a relationship there and they understand how you work, that's fantastic, evidence that a deal could work out well. So it's easier said than done, I realize, but but in terms of just approach, that's what we're here for, is to talk to entrepreneurs and understand what they're doing.
And these guys all get bombarded by VCs like me who have the greatest portfolio company they've never seen before. So, I mean, VCs I think can be helpful, but I know that all these guys get bombarded by both us and our colleagues. So.
But I know Charles, and I will take Charles' phone call because he's a good guy, and I know he's not totally full of BS.
All the time.
Okay, so when everyone else bum rushes the corp dev guys, you go after Charles, get to know him. That's your backdoor in. Yes, sir, in the back.
If you feel a company is interested in talking to you about buying a company that is not completely sure and also doesn't manage the process very well, and is distracting to your organization, what do you feel about kind of setting a deadline or trying to create a point where going forward you're not going to close it off if it's distracting?
How to create a deadline, urgency, some sort of yes or no?
So I'm not sure I understand. From your perspective, the target?
Yeah.
Is that, I mean, for me, it's very clear that somebody wants me to be respectful of their time when they say, how long is it going to take here? Are we talking multiple months or are we talking a few weeks? And any acquisition professional should be able to say, look, our process looks very much like this, and it's a 3 to 4 week process and you should have an LOI in your hands, or not, right? But either way, you're going to know. And if you can't get that, then I would lay out a time frame yourself and say, if we're not there, then I've got to go and run my business. I think it's fair to establish a deadline.
Isn't it probably safe to say if it's not moving forward on a pretty nice clip, your odds of it closing are probably slim? I mean, I guess big deals take time, but isn't the pace of a deal kind of indicative of whether it's going to close?
Yeah, I mean, if you're not getting a responsive back and forth, and if the process is not looking deliberate, then you should, take that for what it is and not put a lot of time into it.
Maybe one or two more. Yes.
As we raised the A, there was a very typical profile of a VC. It's a former entrepreneur who's now working for a VC partner. What kind of people are in the room when you do talk about mergers and acquisitions? Where do they come from?
Interesting background of the corporate acquirers. Who are they?
When you say the people in the room, like us?
like you, yeah.
Oh.
What's the typical background of somebody who's making a decision about merger and acquisition?
Is usually a CEO of a company, because let's be clear, I don't make decisions. I run the process. I make sure the executives in my company had the right information. There's usually a set of individuals involved in each acquisition, and it differs by the size of the company. My company, which is sort of mid-cap, if you like, the CEO, the CFO, the kind of head of the division or label, and myself and a few other folks would be in the room for that discussion. And let's be clear, the CEO and the CFO are making the decision on go forward or not go forward.
Interesting. Good.
From AOL's perspective, it's very much a true statement that we're not the guys deciding, okay, we can go spend $300 million or whatever the number is. But in my scenario, it tends to be much more around here are the parameters, and you can negotiate within these parameters. But anything outside of that, then you've got to take a step back and go and revisit with the team, which, as you say, CEO, CFO, and the kind of business unit owner.
Great. One more. Why don't we wrap it up?
Yeah, I'd like to ask the panelists, when you look at a target
when you look at the brand of the VC firms that funded the company, what's your general reaction? Like, that's a good brand, that's probably a better company, or that's a good brand, that's probably too high a price? Or
Question is there signaling in the VC brand? I like it. Interesting question. Or is there a premium or discount?
I would say yes to you said, is it indicative of quality? Yes. Is it indicative of maybe a higher price? Yes. But, I mean, it's just one of 500 things we'll look at, and it's not dispositive. So.
Okay. Anything else? No? All right. Let's give these guys a big round of applause. They're awesome. And that's it. We're going to do another one probably December or January.